So he's associate director and zonal head of Whiteoak Mutual Fund, and he takes care of the business intelligence sales process of Whiteoak Capital Management. He's got more than 2 decades of experience. His priority role is head of investment product, Citibank, regional investment counselor, Citi, involved in businesses in stock broking. His education qualification is business administration from Cardiff University. And let me take a pause. I need a bottle of water. So his professional experience is observation of role and significance, zonal head, West, his role of business intelligence sales process. Given his background, he's got in-depth knowledge in products, sales. He bridges the gaps between the product development of mutual funds. And let me take the privilege of introducing Mr. Niraj Harlalka. There's a disclaimer actually, there's one old friend of mine. Normally what we do is, when there is a birthday for him, we never celebrate his birthday because the candles are expensive than the cake. Likewise, Mr. Niraj's experience and expertise is more than what the industry is required. Let me take the privilege of introducing Mr. Niraj.
Telling my colleague Ranjit and Sridhar, happy to be back here. Last year I was here. I remember Ajay and some of you had met, and then had the privilege of meeting some of you at another event also. So, happy to meet. When I was talking to Ranjit, I was asking what should we be talking about, because last time I remember we had a very interesting and good discussion. So when I was discussing with Ranjit, I said, it's a very interesting point to start where we left. And does by any chance anybody remembers where we left? That's why. Does anybody remember this slide? Okay. So, when we were talking last time, I asked a question. Do index have factor risk? Does an index have a factor risk? What are factor risk? One point of factor risk is large, mid, and small. One point is where we talk about, let's say, value versus momentum versus those kinds of factor risk. Interest rate can be a factor risk. Quality, thank you very much, sir. Quality is a factor risk. All these can be a factor risk. So can index have a factor risk? And can 2 different indexes have a factor risk? Correct. So why I want to show this is not for anything else, is to understand how funds work. How risk management in a fund is also important. Because consistency of return is what all our investors are looking for, right? It's not the high return that the expectation is always there. A consistent return is more important. So to understand factor risk, at times you will find funds not giving the return, but that will be more because there may be a factor risk that is playing out. So let's look at this. Forget large, mid and small. 2 parts of large cap is Nifty and Nifty Next 50. Can you see what's happened in the last 1 year? But in the 2 years it's opposite, right? Bang opposite. And 10 years, 10% annualize, friends, is a lot of money. But any guesses why this happens? Other than Ajay sir, because I've discussed this with him at length. What if I told you Nifty Next 50 has 0 private banking? Second half of large cap. Would you believe me? But it does, sir. You see, IT is literally missing. Telecom is missing. Power is like nearly 5 times, 6 times. So I don't want to call it that, but in some manner, is Nifty Next 50 like a value index? And Nifty looks like a quality, right? So friends, what I'm trying to say is even an index can have a factor risk. Obviously funds will have, no? And which is where risk management at funds make a difference. A lot of you will remember that a few years back, SEBI never had a classification saying large cap should be so much percentage of the index. Mid cap should not be certain percentage, 65% of the index. Correct? Large cap 80% of the index. Multi cap to be 25% each. Do you remember? It wasn't there, right? Why? Why did SEBI bring this up? Yes, but more importantly, sir, if an investor is coming in a mid cap, he or she is wanting a mid cap risk. And if you have too much large cap there, what are you doing? You're giving them something else. Somebody is coming in a large cap and there is 40% small cap. He or she is coming for another risk, right? I don't know what's it called in the local. You understand what is Mooli? Right? Riders? Now, the analogy I like to give, if somebody wants a cucumber and you give them a radish, what will happen? He or she will feel spicy, right? But if somebody is wanting a radish and you give them a cucumber, what will happen? Will find it really bland, right? That's risk for you, ladies and gentlemen. Our job is to understand the risk of the investor and serve that. But you'll ask me, somebody also has small cap. A conservative, moderate, and an aggressive client all will have a small cap in their fund, right? In their portfolio, sorry. The only thing, it will vary. Aggressive may have 20, 30, 40%. Moderate will have a few bit, 20, 30% maybe. Right? Conservative may have 10% or lower. So the risk varies. And this is what SEBI did. They moderated and told you this is the risk you manage in each fund. So it's become easy for us also, right? This is risk management. And we have to understand this. This is the most critical part of an advisor, if you ask me. I've said this in multiple forums. In a small and mid cap, there are three kinds of investors when it corrects by 20, 30%. One, who's screaming, what the hell have you done to my money? Two, who's sitting quietly, nothing makes a difference in his or her life. And three, who's calling you daily or every second day, can I put more money? There isn't the fourth type, right? The problem is the first one. He or she did not understand the risk of the product. Some friend told him, some relative told him that I made 20, 30%, so let me invest in it. Read it in the newspaper somewhere, right? Remember in school, there was this, in the test we used to get match the followings. Risk is that also. If you have the correct risk for the correct investor, they will be happy irrespective of the market condition. If not happy, they will be sad. They will know what is happening. A lot of times I showed you factor risk, where sometimes value works, sometimes quality works, etc. But the question that you could ask me is, Niraj, how do I know which fund manager is taking how much risk to make that money? Correct? How do you know? I've told you theoretically, but practically, how do you measure it? How do you realize it? Somebody said something. Thank you, sir. Right? Information ratio. SEBI just made it mandatory also. How many of you have seen it? Where can you get information ratio of all the funds? Yes. And by the way, you can get in on Amphi website. You go to Amphi website, say flexi cap, and you'll get a list of information ratio of all flexi caps together. But what is information ratio for the benefit of some of them in simple form? By tracking error, sir. By tracking error. Right? Huh? He's tracking me. But let's make it simpler. Let's make it simpler. Ranjit, my colleague, and myself both have played a test match. And after 2 innings, both our average score is 25. Will everybody believe here that we are same kind of a batsman? Right? Average is the same. But let's look at the innings score. Ranjit in first innings made 30. In the second innings made 20. His average is 25. I in one innings made 50. And in the second innings made 0. My average is 25. Who takes more risk? I'm not wrong. Nobody, it's not wrong. It's what you want to pick. Right? But consistent return is what you want. If I were to put it again back into cricket parlance, we all love watching a Sehwag, right? We all love watching a Sehwag. But technically, we all want a Dravid in our portfolio. Don't we? But Sehwag is not wrong. He's the only guy who's got more triple centuries than anybody else. Right? It's what you want. My point here of explaining this to you is, or talking about this is we need to look at such stuff. The more consistent return, and why is this information ratio important? Then versus an index, if somebody is not going like this, means it's not taking one side of the market always, right? It's a balanced portfolio that they are trying to create. You are not trying to say this is working, that is working, so let me go there. Because only in hindsight can you change portfolio in that manner, in such large magnitude. Right? So start looking, start understanding this risk factor in each fund. You know, one of the key questions that we as Whiteoak nowadays get, or before that, actually these guys will kill me or my boss will. Before I talk about anything else, from the Whiteoak team, I'd like to thank all of you for your support. We just crossed 30,000 crores in our mutual fund AUM. I think in 3 years and a few months, not many fund houses have been able to do that. And that has to be the support of our distributors. So thank you very much. Right? Now, I was coming to the point of a question that we get in Whiteoak the most. What is the difference between a mutual fund PMS and an AIF? How many of you have that question in your mind? None? I'll make it very simple, right? It's not the only method or the correct method, but I'm trying to give it very simplified. Let's take 10 stocks named from all of you. Right? Assume we've taken 10 stocks. Doesn't work exactly like this, but I'm trying to give you an example. Name of 10 stocks. I'll create 3 portfolios here right away. One portfolio of 10 stocks of 10% each, 100%. Second portfolio, 5 stocks at 7.5 and 5 at 12.5, 100%. Third portfolio, 5 stocks at 5% and 5 stocks at 15%. Ladies and gentlemen, what did I change in the 3 scenarios? Not allocation, not weightage. In my mind, I changed the risk. To change the risk, I changed the weightage. Correct? The third portfolio with 5 stocks at 15% each. I'll either make more money or lose more money. relative to the other two in those 5 stocks, means I have taken higher risk. Does that AIF client want you to do that? They want you to do that, right? Because an HNI is looking at an elevated risk. SEBI is also telling you to do that as a fund house. Why? Why is the minimum ticket in a PMS 50 lakhs? Why is the minimum in an AIF 1 crore? You know now there's a 10% cap in a single security in mutual fund, right? In PMS there's no cap. In an AIF there is a cap, but there you can leverage also. You can do FNO. So have you elevated the risk? So risk management is the key. Now let me give you a live example, maybe it will help understand this. I'm keeping a tap of the time. Last time I got bailed out. No, I'm saying last time they bailed me out, so I'm keeping a tap on the time this time. Just joking. Okay, you know, we have a healthcare mutual fund and we have a healthcare AIF. And mind you, I'm not trying to sell any of the funds, I'm trying to give an example on how risk is managed into funds. In my AIF, I have 31 stocks. In my mutual fund, we have 43 stocks, which is okay. But the common stocks are 22. You all with me? These 22 stocks in an AIF, the portfolio weightage is 79. In MF, it is 55. So have I increased the weight of each stock by 1.5 to 2 times? I have, right? What have I done? Increase the risk. What will happen? Either I'll make more money or lose more money. Is that an AIF client wanting that? Correct? Now, also what happens in a mutual fund, ultimately mutual fund is a retail investor product, right? HNI can by all means come in and invest in them, but it's a retail product. So you have to manage it like a retail product. Now, what is one thing in a mutual fund that gets always compared? Index return. That's one thing, every index. So you have to be aware of what the index is. Now, great example here. The healthcare index, Sun Pharma is 13% weightage. If I'm underweight, does it mean I have low conviction in the stock, right? Even if you tell me I have 10%, but other stocks I have very little weightage compared to the benchmark weight, that means I don't have conviction, no? But why have I kept it then? Because the volatility will kill me, no? If Sun Pharma goes up by 10%, will I underperform the index by 1.3% instantly? Mathematical? Can I do that? Can I be, 5.68% Apollo? I have to have something. But how much is the weightage in AIF, ladies and gentlemen? Have I elevated the risk? So if you ever talk to a fund house, any fund house, including Whiteoak, if they bring an alternate product or they make a mutual fund, ask them what is the difference in the risk. What if I told you I had 3 flexi caps, 3 flexi cap funds? Would you believe me? You can't, right? Regulatorily you can't. But actually I do. My special opportunities and quality, I run it like a flexi cap. But what is the small cap weightage in my SOP? 32%. Quality is the lowest. It will all, and quality by nature of other than large, mid and small, there are filters that are there. So which will be the highest volatile product if the three were to be compared? Followed by? Flexi-cap. Where the three? I know multi-cap I am excluding because these. Followed by flexi-cap? Followed by quality? Correct? Remember this slide? Special opportunities, flexi-cap, quality. Does this slide now make sense when you look at the data also? Right? Coincidentally, one distributor in Chennai only. Once I had a meeting with him and he said, I don't like multi-cap as a category. Why? Because they say flexi-cap can do what a multi-cap can do. Theoretically, yes. Theoretically, yes. But have you ever seen a single flexi-cap with 25% each in mid and small? Can't, because the index has 70%, BSE 500 has 70% large cap, 20% mid cap and 10% small cap. Nobody will divert from that index that much, right? So does a multi-cap then serve a different purpose compared to a flexi-cap? In fact, I was looking at the data, and you were presenting some data I saw on the flows, but a lot of people don't realize, large and mid gets as much flows as multi-cap. Actually, in the industry, and it's an ignored, it's a quite a ignored category in IFAs. I was studying the data the other day. X of IFAs, a lot of money comes, but IFAs don't tend to do large and mid. I don't know, for some reason. We spoke about risk. We spoke about cyclicality that can come in, right? Mm-hmm. This category can be the most cyclical in nature. See what has happened in October. And what is the gross flows? 10,000 crores is coming down to 600 and negative now. Understanding and this is where a lot of times investors have a problem because of the cyclicality. So understanding it's not wrong. It's just that the investor should know where they are putting that money. Cyclicality will come. But in this you can get structural changes also. How many of you believe that the growth of UPI that has happened this year, UPI will grow less next year compared to this year? It will only structurally go up. Structurally, can somebody tell me we will use less digital or the growth of digital will be lower next year compared to this year? Can somebody confirm to me that in this country we will spend less on healthcare as a growth next year compared to this year? But can somebody tell me the growth of a cement or a steel or infrastructure next year will be the same or higher growth than this year? The probability, if nothing else, will stand 50-50. So in thematics also, ladies and gentlemen, try and look at the structural change versus cyclical change. And that will maybe give you a little more consistency and the alpha opportunity that comes in. So ultimately, it's about risk management. Right? We need to be careful about factor risk. Factor risk can be happening in even a flexi cap. Because there are styles of managing of each fund, no? Each fund house. And never, it's a difficult job. I've been there, by the way. I've been an advisor. It is difficult to tell a client or explain a client when a fund is underperforming. But please understand, if a fund is underperforming, it may be the factor risk and not the bad fund management. Value will underperform at some point, right? It has in the past. Was it the fund manager wrong? That's the factor risk. So as we chug along from here, I think the markets will do their job, right? We have a slide in our market perspective which shows that how Sensex has moved over time, and in that graph we've not put a single positive event. It's always been a negative event, and still in spite of that, right? So I think it's important. The last message that I would like to leave is that let's understand factor risk. Let's understand what each fund does. I think we've done it in the past, but it's important now to understand what, and importantly start looking at information ratio or such ratios to be more well equipped before we go to the client, because consistent return will make a difference more than higher return. Thank you very much. In case I have a few minutes, in case there are any questions. See, what do you do if regulators, the taxation or ATC benefit is not as much in the new regime, right? What do you do? So that I don't know what will happen, but if you were to see the numbers of ELSS in the industry, it's negative net sales. It is only telling you, right? Why will somebody invest in it? And those who are maturing over 3 years seem to be removing money. See, ELSS falls purely for the ATC benefit, right? If that doesn't exist in the same form over time, why, sir? Sir, actually, I'll tell you why I differ from there. You've seen fund sizes become 20, 30, 40, 50,000 crores. How? Open-ended funds, no? You don't need a closed-ended fund to grow the AUM. Otherwise, these open-ended funds will never become as big as they do, na? But that's regulatory. The fund house can't do much about it, right? Regulatory. I'm happy to take money. I still have an ELSS fund. But they have to be. It's like, sir, I'll give you another analogy. Right? In our own industry. FMP finished. It was a large. When I was an advisor, we used to love FMP. I'm sure everybody who's done FMPs here would love it, right? 3 years, 5 years, money locked in. Benefit to the investor. More or less confirmed return. Taxation benefit was there. All that existed, right? Why did it go away? Why did the fund houses didn't stop? Regulatory changes came on tax. And because of it, no investor wanted to put money. And if no investor wants to put money, fund house will not launch it, no? Even debt today is suffering from that, no? It's marginal tax, no? That's why hybrids are another alternative, sir. You still have some hybrids with 2-year long-term capital gain. Balance advantage funds, I think, are one of the best categories People underestimate balance advantage if you ask me. Balance advantage funds, look in the industry. Good balance advantage funds with 50 to 60% net equity have given Sensex return. The risk reward, ladies and gentlemen, is in the investor's favor. And a lot of people don't realize this. Actually, in a falling market, balance advantage brings in flows in the market without new money coming in. Because the fund manager is aligning more money to equity, no? In a falling market, your equity component goes up, right? In balance advantage. So actually it brings in money without new flows. So, sir, unfortunate. That's there. Any other questions? Happy to. I had to be bailed out.
Let me invite Mr. Imtiaz from Pondicherry to hand over a token of memento for Mr. Niraj. And that was a splendid presentation. Thanks a lot. Lots
My
of
pleasure.
Points to ponder. Thank you. Thanks.
My pleasure.
Thank you, sir. It was a great presentation.
So this is something that I got retired 25 years before.
Happy that I give it to you.
And after which I have never touched it. And always my top floor has been empty. And I always believe, there is a belief for me